The U.S. debt ceiling has been a topic of concern for many years now, and it's not hard to see why. The U.S. government has been accumulating debt at an alarming rate, and there is a real fear that it could lead to a catastrophic crash of the stock market and the economy as a whole. The debt ceiling is a limit set by Congress on the amount of debt that the U.S. government can accumulate. When this limit is reached, the government is no longer allowed to borrow money, and it must find other ways to fund its operations. This usually involves cutting spending or raising taxes, which can be a difficult and unpopular task. The current debt ceiling is set at $28.9 trillion, and the U.S. government is expected to reach this limit sometime in the coming months. If Congress is unable to raise the debt ceiling, it could have a number of disastrous consequences. The worst-case scenario would be a default on U.S. government debt. This would cause panic in the financial markets and could trigger a global economic crisis. The U.S. dollar would likely plummet in value, causing inflation to soar and making it more difficult for the government to borrow money in the future. The stock market would also be severely impacted by a default. Investors would panic and sell off their shares, causing a massive drop in stock prices. This could trigger a recession, as companies would be forced to cut back on hiring and investment, leading to higher unemployment and slower economic growth. The consequences of a U.S. default would be felt around the world. Many countries hold U.S. government debt, and a default would cause these countries to lose money. This could lead to a domino effect of defaults and bankruptcies around the world, leading to a global economic meltdown. In conclusion, the U.S. debt ceiling is a serious issue that needs to be addressed by Congress. The worst-case scenario of a default on U.S. government debt would be catastrophic for the U.S. and the global economy. It's important that Congress takes action to raise the debt ceiling and put the U.S. on a sustainable path to financial stability. Will the U.S. debt ceiling issue affect Singapore? How will it affect Singapore and her stock market? Yes, the U.S. debt ceiling issue can affect Singapore and its stock market. This is because Singapore's economy is heavily reliant on global economic conditions, and the United States is a major player in the global economy. If the U.S. debt ceiling issue is not resolved and leads to a default, it could trigger a global financial crisis that could have severe implications for Singapore's economy. Singapore is a major trading hub and is heavily dependent on exports, so any disruption to global trade could have a significant impact on Singapore's economy. Moreover, the stock market is also sensitive to global economic conditions, and a default by the U.S. government could cause investors to panic and lead to a sell-off in global stock markets, including in Singapore. However, it's important to note that Singapore's strong fundamentals and diversified economy could help cushion the impact of any global economic downturn. The government has also taken steps to diversify its trading partners and promote domestic consumption to reduce its reliance on external demand. Overall, while the U.S. debt ceiling issue could have implications for Singapore, the country is well positioned to weather any potential economic storm. How to protect our investment if the U.S. default on its debt? If the United States were to default on its debt, it would likely have significant global financial implications. However, it is important to note that a U.S. default is considered an extreme scenario and not necessarily a likely outcome. If such an event were to occur, investors would likely see significant volatility in financial markets, including sharp drops in stock prices, currency fluctuations, and possible defaults in other countries and financial institutions. To protect investments in such a scenario, there are a few strategies that can be considered. Diversification. Spreading investments across a variety of asset classes and geographies can help to mitigate risk in the event of a U.S. default. Holding cash. Holding some cash in reserve can be helpful in times of volatility, as it provides the flexibility to invest opportunistically or to meet liquidity needs. Consider safe haven assets. In times of uncertainty, investors tend to flock to safe haven assets such as gold, government bonds, and defensive stocks that may hold up better in a market downturn. Stay informed. Keep up to date on the latest news and developments, including any updates on the U.S. debt ceiling issue, as they can have a significant impact on financial markets. It is important to note that while the potential for a U.S. default is a concern, it is not a certainty, and investors should not make decisions based solely on this eventuality. It is always advisable to consult with a financial professional when making investment decisions and to have a long-term investment strategy in place that aligns with your financial goals and risk tolerance. In conclusion, while a default by the U.S. government on its debt is a rare and extreme event, it is still important to consider how such an event might impact your investments. Some ways to protect your investments in the event of a U.S. default include diversifying your portfolio, reducing exposure to U.S. debt securities, holding a cash reserve, and hedging with assets such as gold. It is important to work with a financial advisor or do your own research to determine the best course of action for your individual investment goals and risk tolerance. Ultimately, the best defense against a potential U.S. default is to have a well-diversified portfolio that can weather different economic and political environments. Take care. And I see you in my next video.